We talk about 1031 exchanges on the show. We asked Brian to explain how a 1031 exchange would work when it comes to taxes, and to give us an example of somebody doing it from out of state, since we know a lot of you are out of state investors. So here's his answer.
Much like we were talking with depreciation, generally a 1031 exchange is a deferral. So it's a tax deferral. If you own a property in Minnesota and you didn't like the Minnesota real estate market anymore, you thought that it had hit its peak, and you said, okay, I want to have Jacksonville. And you said, okay, I have a gain in this Minnesota property of $600,000. You could roll that gain into the property in Jacksonville and not pay taxes on that gain, as long as 100% of the proceeds went into the new property. So there's this concept that the IRS calls boot. If you receive any boot, which in most cases is cash, or the other one where we see is a little bit of a landmine, is if debt is paid off. If debt's paid off and you don't have new debt on the new property, that is deemed boot. So if you had a property with a $200,000 debt and that was paid off, and then you just rolled the net proceeds into a new property, but you got $200,000 worth of boot cash that was received to you. If you had $200,000 in the old property of debt and $200,000 in the new property, then you're fine. So we see lots of 1031 exchanges. It is a tax deferral strategy. You get a carryover basis because it's tax deferred. So the old basis, going back to our Minnesota example, if you had this property in Minnesota that was $100,000 and you bought a property now in Jacksonville because you had this $600,000 gain, you have a $700,000 property you bought in Jacksonville, well, your basis is what your old basis was. So be mindful of it, because you keep rolling this over. Just be mindful of an exit, because if and when you ever go to sell them, I mean, some people we've seen up north, these people have selling these properties, these commercial properties for years and years and years, and you wait until you die, and you get stepped up basis under current tax law. So then you have 1031 everything, you never pay any gains, and then you pass away. And if you properly plan for the estate taxes, the beneficiaries get a stepped up basis at death, but it's outside the concepts here. So carryover basis tax deferral. Make sure very clear that you have a QI, a qualified intermediary, very early in the process. Sometimes people will say, oh, I just sold my property and I now want to do a 1031 exchange. No way. There are some ways to do some reverse 1031 exchanges, but I would make sure, if you have any thought of doing a 1031 exchange, make that you select your realtor and then immediately go talk to a qualified intermediary. As we talked, dollar for dollar, make sure everything is going through the QI. If you have debt, you're taking on the same amount or more of new debt, because any cash that you're receiving, any of the debt payoff that you're receiving cash, it's basically a pro rata gain. So if you had a $600,000 gain and you received 20% of the proceeds, 20% of the gain is taxable to you. So we have seen many cases where that debt pay down is not accounted for, and then it's a bit of a mess on the tax side. You can bring new cash to the deal. If, going back to the Minnesota property, you move this property down and you had to bring new money into the deal, so then you would have the carryover basis plus the new money you put over into the deal, which you're always going up. In 1031 exchange, you can never go back unless you want a portion of it to be taxable.
All right, GC. So just to explain 1031 exchanges, if anybody's here, they haven't heard of it, quick explainer on that.
It's a tax deferral strategy. It allows you to sell a property and reinvest it into one or more new properties, and to not pay the taxes at the time of sale. So the way I think about this, and his example was great, is this allows you to put the most assets in your army of income producing assets. Because in that example where Brian was talking about that $600,000 gain, if you just sold that property and you had to pay capital gains on that property, I mean taxes at the time of sale, let's just say when it's all said and done, that comes out to 25%. That's $150,000 that you have to pay at that time. But if you do a 1031 exchange in this example, and you have that $600,000 gain, now you bring that whole $600,000 to go and buy your portfolio of properties in Jacksonville with JWB, let's say. And that's the difference between having 3 or 4 properties in your portfolio or 4 or 5. Because if you paid the tax right off the bat, you give 150 grand away, you only have 450 grand of working capital. That's 3 or 4 properties. If you do the 1031 exchange, you go and you buy a portfolio of rental properties with JWB. Now you have the full 600,000, and that's probably 4 to 5 rental properties. So this is all about maximizing the amount of assets you can put in your army of income producing assets.
Got it. So if you bought a property for $200,000 in Southern California 15 years ago, it's now worth $800,000. You do a 1031 exchange. That means you can buy $800,000 worth of properties in Jacksonville, Florida with JWB, which if you are financing, that means you can buy 10 or whatever, right?
Right.
As opposed to cashing out and then being able to buy about $600,000.
Exactly.
Right. So easy peasy. Now, what he's talking about, right? So there's a couple of rules that have to do with 1031 exchanges. You have to do it and identify the property, make sure that you're going to be able to close it within the time frame that's provided. But he also mentioned something I don't think we've ever talked about, this idea of boot, right? Like one of the rules in 1031 exchange is the fact that you have to, it's a growth strategy, right? So you're going to have to buy as much or more of what you just took out of the old property in new property, right? This boot concept, if you have to take on at least as much debt as before. Had you ever heard of that before?
I get mixed up in exactly what boot means, to be quite honest. I know, I know enough to be dangerous, but what it comes down to is just maximizing the tax savings component. So that's why you need to work with, you heard him talk about a QI, a qualified intermediary, right? This is somebody who is well-versed and an expert in setting up your 1031 exchange to make sure that you are maximizing the tax savings. When you start to throw debt in the mix, there are other things that you have to take into account. It does get kind of hairy, and that's where boot comes into play. So this, I think, is the value of the team here. Your CPA is a part of this strategy for sure to help guide you here. Your qualified intermediary is the blocking and tackling, how to set this 1031 exchange up so that you maximize the tax savings and are not left paying taxes on the boot.
Got it.